Hello, I'm your mortgage lender, Rob, and welcome to 10 Minute Tuesday. This is a live and recorded video I host every few weeks where I'll be sharing some real estate and mortgage news, tips, hacks, and updates in 10 minutes or less. So Q&A at the end, so drop your questions now or whenever you are ready to ask a question, or at the end, unmute yourself if you have any questions for me. So let's get started. Today's topic is having multiple VA loans, a little bit about VA loans. So I'll explain a little more about that. But first up, quick update on rates. This is general kind of where things are at and what's happening. So conventional and government loans, your FHA, VA, USDA, everything's kind of in the sixes to high sixes right now. These are actually from last Friday as we're recording this, so small change since then. But the news is the Fed did not raise rates for the first time in over a year, but they did indicate 2 more hikes this year, up to 2. We're expecting 1. The market's pricing in 1. We've seen a small increase in rates since they had that meeting last week. And if their next meeting, they say they will do a second rate hike this year, expect more rate increases. So anybody who's saying rates are going to drop this year, I don't know if I would agree with that. I would say rates are probably going to stay where they are and keep going up. So that's that. Let's get into the topic at hand today. So talking about multiple VA loans. So first of all, yes, it's possible. A veteran can get a second VA loan without selling or refinancing their first. So today I'm going to give you some technical examples of how that works. It's not really important for you as a buyer or a real estate agent to know how this works, but it's just an illustration of what it is. So some little bit about the nuts and bolts. So how this works. So VA loans, they have something called entitlement. Every veteran or VA eligible borrower, as we call them, has entitlement. Entitlement starts at $36,000 plus their bonus entitlement. There's a reason for that. Not important today. It has to do with when the VA started versus where they are today now. A person's first VA loan has an unlimited borrowing potential. Unlike conventional and FHA loans that have a cap at their county's loan limit, VA is unlimited for the first loan. But the subsequent loans, if you still have the first out, have a limit. And that's based on remaining entitlement plus bonus entitlement. So we'll go into the details on that. But the summary is a smaller first loan, which is the loan they have on the current house, compared or plus their, the smaller your existing loan is and the higher the county's loan limit where you're buying is equals a greater potential borrowing. And we're going to go over 2 examples, Los Angeles and Kern County, to show. Now, these are real world examples of a friend of mine who I pre-approved who is looking at a second VA loan. So this person bought a house a few years ago for about $350,000. They financed $358,000 because of the VA funding fee. They charged $88,234 towards their entitlement. That's just 25% of the amount because VA guarantees 25% of the price you pay for a home. That's why VA loans have no PMI. It's kind of like having 25%. I wouldn't say down, but more like it covers the place of mortgage insurance. So that's the benefit there. So that's what that number comes in. $88,234 is 25% of $358,000. The Los Angeles County loan limit right now in 2023, $1,089,300. So that means that the VA will guarantee up to 25% of that. Math on the screen here. That means they'll guarantee $272,325, 1/4 of the price, 25%. So you do a little math here. You take the difference of those two. So that max VA guarantee, 25% of the LA County limit. You take $272,325 minus their charged entitlement. That number in the first bullet we generated, 88,000 and some change. Take the difference, 184,091. This is the number we use to figure out how much a person can buy with 0% down on another VA loan. Since they give a 25% guarantee, you just divide by 25% or multiply times 4. In this example, that person who paid $350,000 on their house a few years ago wants to buy in LA. They can now buy a house for $736,000 with 0 down. Now, this is big because this wasn't always, this didn't work a few years ago because LA County loan limits just a few years ago were like under 700 or 800,000. I forget exactly. It changes every year. So as people buy homes and prices go up, which means loan limits in the areas go up, that means that they can buy more and more house than they could a few years ago. So if someone got a pre-approval or wanted to see if they could buy another VA loan and they were told, oh, you can only borrow $100,000, which was the case a few years ago, it's probably changed now based on these new loan limits. So now the first question that I may get is, can you buy more than that example, $736,000? Yes, you can. If a veteran wants to spend more than their limit, They just have to cover 25% of the difference. So if they want to spend $100,000 extra, instead of 736, they want to go 836, they're responsible for 25% of the amount over their limit. So if they're going to spend an extra 100,000, that means they're going to be responsible for $25,000 down. So when you look at 25,000 on a 836, that's not really that much. 25,000 divided by 836, that's only a 3% down payment. Did I do that right? 25 divided by 836. Yeah, 3% down payment. So it's really, really flexible. So that I hope that makes sense. We're going to go over one more quick example, Kern County, because they have a lower loan limit. We'll just zip through these numbers real quick. So same thing. Buyer paid $350, finance $358, charged entitlement $88,000. I'm going to round off. Kern County loan limit $726, about $300,000 less, actually about $350 less. The max VA guarantee in Kern County, 25% of that, so $181,000. We take the difference. $181 minus $88,000 gives a new max VA guarantee, 25% of that. Or excuse me, new max VA guarantee $93,000, which is the max VA guarantee. Multiply by 4 or divide by 25% means $373,000. So a person in this example who bought a home for $350 a few years ago in Kern County with a VA limit, all loan limits, FHA, conventional, VA together. FHA's got a different one. So conventional, VA limits. Beside the point, that person can buy $373, 0% down in Kern County. So you can see how there's a difference, a pretty big difference based on the county and the loan limit that they're in. So yeah, that's it. So, there we go. So you can see how this makes a huge difference depending on the area. And most importantly, that it's possible to get a second VA loan even if you've already used your first. So super powerful. These are two examples. Definitely talk to a lender or have a lender talk to your buyer, yourself, whoever, if you're watching this, about how much you can buy for a second one. And also to make sure they understand it. I didn't know this stuff for the first 5 or 6 years of being a lender. I've been a lender since 2014. So it took a bit to me to really understand how this worked, and I realized how simple it actually is. So a quick bonus tip though. VA is the most flexible when it comes to using future rental income from the house you moved out of to help you qualify for a new home. Now, every loan type allows this with stipulations. VA is the most generous. So VA, the premise is this is if you move out of your house that you own, that you're living in, and say you're going to rent it out, you can use that future rent as income to qualify for your next house. Most of the time, you have to meet certain requirements. FHA is the toughest, being one, you've got to move 100 miles away. VA has no distance requirement. You don't even have to provide a security deposit, which other loan types require that. And in some cases, we can even get away without providing a lease, provided the appraiser verifies your home that you're moving out of is in a strong rental market. So what that means is veterans have a lot of opportunity to use income from the house they're moving out of to very easily qualify for their new home. Oh, and the bigger benefit another big benefit is normally when taking future rental income, you have to minus 25% of the gross rents to account for expenses. VA doesn't do this. They give you the full amount of the fair market rent of the property. So basically, it just allows you to just completely wipe out that mortgage payment on your house you already have. Now, you can't get extra income, so it only offsets your mortgage. But again, details, no big deal. But VA is huge. So definitely, I hope that's helpful understanding about how the VA loan is very flexible if you want to use your VA benefit again without getting rid of or refinancing or selling your current VA loan. Any questions, drop them in the chat or feel free to unmute yourself. I don't think I see any. So thank you for attending and have a great rest of your week.